everyone, this is Demo Gonzalez of Heartwood Financial Services. Hey, Happy New Year to everybody. Hey, welcome to our latest market update and outlook video. It's actually a recap of 2025. And so with this video, I'm going to highlight two of the biggest lessons that I learned looking back at 2025 and everything that was going on. Could have been more than two lessons, mind you, but we got to keep these videos within normal attention spans. And as always, we talk about what's going on with the economy, some of the latest news with what happened with Venezuela and Maduro and how that's going to affect the economy as well. So let's get going. All right, so let's start with the asset class returns for the end of December 2025, which also marks the full year. So as you look at the chart, you can see real quickly that international stocks did phenomenal. It was the first time going back to the early 2000s that we had international stocks actually outperform domestic stocks, and a huge 35 and 24% for international stocks, developed markets, and emerging markets. The next big one was still domestic stocks. Still had a pretty darn good year, almost 18%. This is the third year in a row with double-digit returns. Pretty impressive. Outperformed small caps, which were only up about 6%. We're seeing some potential signs of life here at the end of the year, but they're still kind of, starting and then running into some issues. And real estate had a pretty lousy year with interest rates going down. I think that things might start to look a little bit better for real estate, but it was a struggle for sure. We also had the bond market that did pretty well. This was actually a pretty big surprise with interest rates coming down. It actually did help the bond market, up 7% for the aggregate bond and 8.79 for high yield. And another big winner was commodities. So commodities, especially led by gold. We're going to be talking a little bit more about that in the outlook, where it was up big. Oil prices were down, so that actually muted some of the returns for commodities, but still a pretty darn good return overall for commodities for the year 2025. Now let's talk about what's going on here in the economy. Here are the inflation numbers. I did the CPI this time. I've been doing the PCE for many, many months because that's the Fed's favorite inflation index. But it was getting a little stale due to the shutdown, all the delay of information. So I wanted to give you the most up-to-date one. That's the CPI, showing a 2.7%, which is the all items number. And that is versus 3% in November. So that is a massive drop. That is the biggest drop that I've seen in a couple of years, so that was really, really exciting to see. The core CPI also came down. That excludes food and energy. So it wasn't just food or energy that really made the difference. It was pretty much overall, especially shelter costs, which make a massive part of CPI. So this is a very good sign. We're starting to, we're getting some naysayers that say that the data was still a little corrupted by what happened with the shutdowns, and there might be some truth to that, but the trend is definitely going in the right direction. So this is going to make the stock market very happy. And here's a quick update on what's going on with the Fed. They had a meeting in December. They did another Fed rate cut of 25 basis points. That's 0.25%. So now we're at 3.5 to 3.75%. So this is our third cut in a row since September. So this has been a nice little tailwind for the stock market. Going forward, looks like it might be a little tougher to get those rate cuts. But Jay Powell is going to be retiring or going to be asked to leave in May. I think he's going to go ahead and do so, and so Trump's going to get another officer that he's going to be able to replace with somebody that's maybe a little bit more dovish, that maybe sees things more his way, which is more rate cuts. And so it will be interesting to see, but I think that actually means that there could be a few more rate cuts this year than the market is kind of anticipating. They're only really counting in one more rate cut this year, but it could be 2, maybe even 3, especially if inflation keeps doing what it just did, as I showed you a moment ago. So we'll have to see. And then for the big three report, these are the three biggest leading indicators for the economy. The ISM manufacturing number came out just a few weeks ago at 47.9. So this is actually a trend that's been negative. It was 48.71 last month. Now it has been below 50 for over a year, so it's not the end of the world, and manufacturing is not the biggest part of our economy, but we're trying to bring this back. So this is actually a sign that some of the tariff stuff isn't really bringing the manufacturing stuff back as quickly as we'd like to see. I'm sure there's a lot of people that are still a little nervous about, are tariffs going to still be around? Can we make long-term commitments just based on what's happening through executive orders versus running it through Congress? And the Supreme Court is, looking at adjudicating what's going to happen here. So we might be finding out here very soon if the administration is going to have to come up with some different ways to do these tariffs. So again, manufacturing PMI has been weak, and that's been the trend for quite a while. But the bigger part of the economy is services, and that's been showing a lot of strength. In fact, we went from 52.6 last month to 54.4. That's a nice jump in the bigger part of our economy, so that is trending up. I would say that is the more important piece to look at there, and it was very strong. And then breaking news, we had the BLS employment report and the rate that came out just this morning. I'm filming this in the afternoon, and so the number was 50,000 new jobs and a 4.4% unemployment rate. So this is kind of weird because it shows 64 last month, so we grew but not as fast, but the unemployment rate went down. And so there's a lot of stuff going on here. There might be a little bit of noise with the shutdown, but there's also noise because of what's happened with immigration. And so AI is also displacing some things but creating a lot of productivity. So it's going to be interesting to see how this number develops over the years, or more like the months. But it has been rather weak. This is one of the reasons why you've seen the Fed acting the way they have. They've been cutting rates. So if this continues to be kind of weak, but not too bad, you'll see the Fed continue to cut rates and the market could be happy. If this goes down way too much and the Fed's cutting rates because they're afraid of a recession, then that's a different story for the market. So that's something that we'll be watching closely. And then, of course, I watch the news just like everybody else does. I woke up Saturday morning and I'm like, what in the world is going on here? We just went and pulled and snatched Maduro from Venezuela. He's in our possession now in New York City. How is this going to affect the stock market? The way I would ask you to look at geopolitical events is, how is this going to affect natural resources? Or is this going to start a war or anything like that? So I would say with Venezuela, this seems to be a very targeted type of exercise. So I don't see this going into some full-out war. But I do see it having a potential impact on the oil markets, being that Venezuela is a pretty big producer of oil. But I wanted to show you this chart here, because you can see here that currently Venezuela only produces about 1 million barrels of oil. They used to produce over 3 million barrels of oil. This is per day, by the way, so it's a lot. But it's only about 1% of the 100 million barrels that are produced every day. So the point of bringing this up is their oil production is way down. It doesn't make a big difference in the world markets. And even if it were to go really bad and it goes to zero, it wouldn't have that big of an effect. And if it were to go superbly well, it goes back to 3 million. Again, it's not going to have a very big effect in the world oil markets. And so that's why you saw the stock market kind of just do a meh on this whole thing. And I expect that not a heck of a lot will happen going forward. This is a long-term thing where we're going to maybe get back to those 3 million barrels per day. The bigger news really is what's going on with Iran. So that's just starting to develop. We'll keep an eye on that because they are a much bigger producer of oil. So a lot going on, a lot to be keep on the radar here. All right, the two biggest lessons that I learned from 2025. Number one, diversification beyond paper assets. And what do I mean by that? Paper assets are stocks, bonds, things like that, cash. So it turned out that it was a really good idea to have some gold and silver and real estate and other hard assets in your portfolio in 2025. There's a lot of reasons why gold did as well as it did, but the biggest reason was the fact that the dollar was going down. And when the dollar goes down, gold is priced in dollars, so gold goes up. And so could this persist? I think it could a little bit longer. You know, we're still in these tariff talks. We're adding tariffs. It's slowing down global trade of the dollar being used. And so with the dollar's use going down a little bit, the value of the dollar will take a little bit of a hit. And we are also seeing other countries put into their balance sheets more gold. So there's a lot of federal governments that are putting into the reserves gold because they want to diversify from the dollar. They got, especially China and Russia, when they saw what we were doing with the sanctions, they got a little scared. So having more gold as an alternative trading currency to the dollar had a big trend in 2025. Can that persist? Possibly into 2026. We'll have to see, you know, if there's some resolutions with what's going on with Ukraine and Russia. If the tariffs kind of at least quiet down a little bit, that will, all those things will help the dollar and will be very good for the market, of course, but not so great for gold. But again, having that diversification piece there was huge for 2025. And finally, the other big lesson that we learned in 2025 was the patience rewarded investors. Now, this is a lesson that is really working all the time, not just in 2025, but it came up again in 2025 as we saw the tariffs being brought in by the administration, and it really brought a lot of panic into the market. In fact, we almost saw a bear market. It was this close from a bear market in April. We were down 19% in a very short period of time, and a lot of people got very anxious. Some people panicked and sold and got out of the markets. And as we see in very short hindsight, the market recuperated everything and actually had a pretty good year in 2025. And as you can see in this chart, the red dots show every time the stock market was down 30%. If the reactionary investor were to sell, go to cash, wait a couple years out, and then reinvest into the stock market, their performance over this huge period of time, I think that's about 85 years, would have been $745,000 at a starting point of $10,000 versus just staying invested in the equity markets and getting up to $6.4 million. What a massive difference. Now, this is a long period of time, mind you, but it just goes to show you that that missing out of the recapturing when the market starts to come back is so hard a time. You miss that. It makes a really big difference. And in fact, I thought this was interesting. Just looking at a balanced investor where you were 50% in stocks, 50% in bonds, you would have done much better, $2.2 million in that kind of scenario, taking less risk pretty much the whole time with that balanced portfolio. So it just goes to show you panicking, timing the market is very difficult to do, oftentimes can hurt you. So big lesson from 2025. All right, the last piece we have here are the Heartwood implications. This is the most monochromatic chart you've seen in a while because everything is just kind of neutral, and I'm not currently really aggressively making any changes in the portfolio. The one thing that I would emphasize is this term that I made up called assertively rebalancing. You know, I go into the portfolios on a regular basis and I do rebalancing, but sometimes I just kind of wait, you know, depending on how the trends are with the market. And so right now, what I'm saying is I'm going in there and I'm assertively going ahead and doing those rebalancing moves. In other words, selling the things that have gone up a lot, buying some of the things that maybe have underperformed a little bit. And we are potentially seeing a little bit of that rotation going into 2026. This could be the year where we see some of the other stocks other than the big Mag 7 do a little bit better, maybe even the small caps as well. So it would be timely to do some of that rebalancing anyways. But I'm still a little bit concerned about things, with the labor market, with the tariffs, and inflation's not completely licked. So there's some things that I'm still a little bit concerned about. So I'm still being neutral, but and taking a little money off the table off of tech, high cap or large cap tech, especially with the huge run-up we've had over the last 3 years. But at the same time, keeping that exposure, because what got you to the dance is usually who you want to take to the dance. You know what I mean? And so we're going to continue to stick it out with that exposure, as well as having a good diversified approach overall. All right? Thanks for watching, guys. I hope this answers any questions that you might have. Please feel free to share this video and share my information with anybody. I'm always happy to help. But again, thanks for watching, and God bless. Bye-bye.